All right. Good morning, everybody. Some of the move that we saw last week came from CPI numbers. Those are a direct reflection of how the battle against inflation is going. And we're going to get more inflation numbers this week. We'll also be getting PPI numbers, retail, housing, jobs. So we got a pretty decent week. One of the things that we want to continue to focus on is energy. Energy is a direct relationship with inflation, and CRB is made up of like 40% energy, and it's a commodities basket. So by keeping track of the CRB, kind of get an idea of what's going on in commodities and energy, and then looking at US dollar Canada is a great proxy for like the cost of energy. We got some levels this week to work through. On the bigger picture, these levels are on the roundies. So at 4,000, 4,100, 4,200, 4,300, they're just big round numbers. You don't have to worry about those in big detail. It'd be the smaller things, right? The thing we do each day in the morning briefing that kind of fills in the gaps in between each of these levels. If you want to read through this weekly analysis, when you're on my website, it's here underneath the morning briefing where it has the word here. So if you click that, I got to do a better job of highlighting it, but if you click that, it will take you to this summary. I always put a date on that summary so you'll know when it was written. I wrote it Friday afternoon before the market closed. So if there's something that is off or wrong, it's because I was a little early. We got a lot of European central banks speaking today, and then a few US Fed speakers. Mostly we're expecting them to kind of sing from the same hymn book, so to speak, right? We're not really expecting anybody to step out of line and to say anything crazy or extreme. We do have Form 13 filings today. It'd be another week, I'm sure, before we can get to the data. So we can kind of get an idea of how hedge funds are positioning for the end of the year. See if there's really going to be, performance chasing as we wrap this 2022 up. Right now, the biggest threat is with the Forex markets. With CPI out of the way and FOMC out of the way, there really isn't anything else as drastic and extreme that could derail this end of year rally outside of the Forex markets. So it's the number one thing you want to pay attention to right now. We're going to start on the daily to point out that we've got some serious levels overhead that need to be resolved. It's the 200 period moving average, which for me That's a purple line. And if you notice, I have two purple lines. This is kind of my solution to the age-old question, should we use the EMA or the SMA? My answer is use both. There's a reason it's worth it, right? There's this big, say half of all the traders out there are using EMA and the other half are using SMA. And our job is to try to figure out what everybody else is seeing so that we can either jump in front of them and front run those big institutions, or we can get behind them and ride the wave like a surfboard, right? But what we don't want to do is try to fight big money. Well, if everybody's using in a 50-50 split, one or the other, then only using one and ignoring the other just doesn't really make much sense, right? It sucks to have extra moving averages turned on. You know, it's a lot of junk and trash on the chart, but you don't have to leave them on, right? You just turn them on, see the levels that you need to see and mark them out and turn them back off again. We are coming up into the 200 EMA, and behind that in a dotted line, we have the 200 SMA. 40.29 is going to be a significant level of resistance. And I point out in that run up, you know, from we had that August lows and we rebounded up right into the 200 and dumped again. And before that, on the August rally that ended, right, when we were coming out of that June, July base and then July, August rally, it ran all the way up to the 200 SMA, stopped and dropped. So both of these provide insight. I wouldn't want to pick one or the other, right? You really do want both. They are the only moving averages over our head to be concerned about right now. Everything else is underneath us, which is another reason I wanted to come out to the daily. Look at how absolutely far away we are from the 10-period daily moving average. I hate the words overbought, but we are well extended past that 10-period daily moving average. The white line here, that white moving average, is a 3-period moving average. 3, 4, kind of swap it back and forth sometimes. Either way, we're a long ways away from that too. All right, so we've outrun everything. We're also this week going to get a 2050 cross. So, you know, that's I think it's been referenced as the silver cross instead of the gold cross, right? But it's a significant cross level. So we've got decreasing bearish strength. We have bullish momentum, and we are in a surge. When you actually write out all those levels, you end up with quite a number of pivot points that kind of fill in those holes between the roundies, right? I mentioned at the start of this 4,000, 4,100, 4,200, 4,300. And we really could run all the way up to 4,300 and we would still be considered in a bearish market, right? Because until we get past that 4,300 and we start, we close above it, we set bases above it, and then we move beyond it. Anything underneath 4,300 means that we're still in that. Volume is a little light this morning, not enough to be concerning, but close. Right? I really would have expected more out of the market this morning. With the the bond market was closed Friday. I just expected more this morning. So we're not underneath the critical level. If it was below 75, I'd be concerned. But the fact that it's sitting down around 100 kind of has me looking around asking, what are we missing? What's the big one that's on the table that everybody's waiting for? We do have additional auctions today. We have the 3-month and the 6-month. Those are at 11:30, so you definitely want to watch the clock on that. We're in a really tight range this morning. When we think about initial balance, the IB, it's the first 1 hour of trading when Globex opens. So from 6 o'clock until 7 o'clock, that is your initial balance. And it's a really tight range. And the idea behind this is when you have a really tight range in your initial balance, it kind of implies that there's still a lot of work to be done today, right? If there was a big moves in that first hour, then it implies that all the work is done, or at least a large part of the work is done. And you kind of have to try to argue about why would they come in and do more work. It looks like they've already accomplished what they were trying to accomplish. But when the range is really narrow, then the implications are that they have not yet come in and moved money around. They haven't accomplished their tasks. And at some point today, we're likely to see a big move. That's not me bringing up that theory, right? That's just the theory of initial balance. It's not my theory. It's just what the theory is. If you wanted to get more information on that, or kind of dig deeper into initial balance and how to read it, analyze it, that kind of stuff, I think Dalton is probably one of the biggest names out there when it comes to that. And then behind him, Peter Resnicek, right? Peter is like a protege of Dalton. It's not needed, right? Especially if you're not using TPO charts and things like that. But at least understanding initial balance and the theory and how to use it in your analysis, that would be the source that I would recommend. So we still have a gap close from Friday. Easiest way to mark that gap off is to just come out to your daily chart. I want to focus on where the market closed. And when we talk about the close, well, there's the 4 o'clock close, and then there's the 4:15 close, and then there's the 5 o'clock close. Which one of those are you supposed to use? Which one are you supposed to mark? Well, if you just come out to the daily, whatever the broker decided was the close, that will be where that daily candle close line is, and that's where you can snap your line. Simple, right? It just removes all the doubt, all the ambiguity, the uncertainty. Well, gee, I don't know which close to use. Use whatever the broker used. So you can see we have not made our way back up there. That means we have a gap to fill. So the idea would be that we are in a really tight range this morning. We have a lot of work on the table that has not yet been done. And the market has a lot of energy primed and ready to make a move. It's like a market waiting on a catalyst. Kind of give me a reason behavior this morning. Give me a reason attitude. We've crisscrossed through the daily pivot enough times this morning to basically invalidate any trade idea off of that. So we're not going to get any help off of the daily pivot. We've also crossed through the open, the Globex open, enough times that we don't have any value out of that one either. 39.96 Globex high. We get through that. We'll deal with the close from Friday. Then Friday's high, which was also the previous week's high, to double pivot. Beyond that, ADR half at 40.31 and ADR full at 40.80. We are above the weekly pivot point significantly. It's all the way down at 39.15. To get down to that pivot point, we would have to break through our own Globex low, 39.77. The open from yesterday's cash session, 39.71. a monthly pivot point or a monthly level of concern, 39.60. And then the low of yesterday, the RTH low, 39.51. There's another low in there that needs to be marked. It would be the Globex low, 39.57. And the 4 o'clock close from Thursday into Friday, $39.63. The Globex high from Friday morning ties in really close with where we closed. So you could mark it, but I mean, it's pretty close. It also is really close to our own Globex high this morning, overlapping pivot points, right? Which is really good. So we got a lot of levels. And right now, since we are inside day, that would be the first thing that you want to focus on. So what I hear from a lot of traders is, well, I thought it was going to be a trend day and I tried to trade and I got chewed up. And then after I got disheartened and I lost a lot of money and I gave up for the day, the market broke out after lunch and it ran. And of course, I wasn't trading it because I'd already got my butt kicked and walked away. You're looking to avoid that. One of the first things that you could focus on is, are we within the Globex range? If we are, and you try to trade that, you're very likely going to get chopped up. I'm not saying don't trade it. I'm not saying that it's not tradable. I am saying that if you're getting chewed up in a lot of chop and you want to try to avoid doing that, don't trade the cash session when we are inside the Globex range. At least let it get out of that. That's a pretty tight range this morning. And beyond that, from our own Globex high to the high of yesterday, that would be a zone. And then from our Globex low to the cash low of yesterday, that would be a zone. It's 3 zones to trade in, or 3 zones to focus on, each with their own pivot points, structure, levels. Since we do have a range this morning, you can use the quant tool, kind of throw your pivot points to the upside and to the downside. Those will give you additional levels as well. The main ones to focus on will be 50% and 100% of the range. 100% lines up with the Globex low from Friday. So it's always nice to see when your analysis lines up with previous analysis. Kind of implies that you're doing it right. Right? When you draw lines or you measure something and it doesn't line up with anything, has to cause a little bit of concern, that you've just got some random line floating in the middle of nowhere that doesn't go to anything else. Ten-day, 30-minute volume profile. We are at the top of the profile. When we're at the top, we expect to go to the bottom. When we're at the bottom, we expect to go to the top. If we break out, there's no volume resistance from this that we could focus on, obviously, because we're at the top. So a move below 39.60 would drop us into a shallow area that we tend to move through really quick. So basically, if we break Friday's low, it's an air pocket drop down to 38.85, and it should be a really fast move. Not a lot there to slow us down or hold us up or help us out. We did tag that VPOC that's been on the charts for a while, so we get to take that one off the board. We hit that Friday. We still have one underneath this from Thursday that we're carrying forward. We have new purple lines, which I know are probably really hard to see in the live stream, but I make them that way for a reason, because I want them to be hard to see. The idea is if I want to see them, I can focus on them. They are there. But for the most part, I can look at my charts and ignore them. Friday won't have a VPOC that we can carry forward. We've already crossed through that zone enough. There's no reason to bring forward the value area high and low, since it is really close to the high and low of the trading day. We have no overhead VPOCs to deal with, but we do have a pivot point at 40.56. It's a CPI level. So back out to the daily again. Right now, the lower indicator is set to a weekly time frame, and the candles are set to a daily time frame. The lower indicator is asking how far away from the 10-week moving average are we, and where has the average reversal been for the ES when it comes to the 10-week. Generally speaking, when the ES gets somewhere between 3 and 3.5% away from the 10-week moving average, it pauses, it stops, turns around, goes back, that it does not continue to move farther away from the 10 at that point. That's what I built this indicator to do. So you can see how we're in that area. We're right around as far away as the market likes to get. Anything beyond that is going to start to get extreme. And that there's an expectation that we're going to pause here, consolidate, and give that 10-period moving average a time to catch up. But it's a 10-week moving average. So it takes some time. Flip this lower indicator over to a daily and ask the same question. How far away from the 10 are we? And where is the average turning point? Well, on Thursday and Friday, we were really close to 4% away from the 10-day moving average. And that's higher than we've been over the last 2 years. So, Thursday and Friday was such an aggressive run. It was so big. We moved so far that we outran the 10 farther than any other time in the last 2 years. And that's why I made this indicator. If we think of 10 as the center of the basketball court, when you get to the edges of the court, there's nowhere else to go, right? You have to turn around and go back towards the center again. We are definitely in overbought territory. And I don't like that phrase, but there's not a better one to use. It's ran, and what we're trying to measure, have we moved too far, too fast? And the answer is yes. We have moved too far, too fast. It's time to pause. So when we think about that pause, the size of the initial or the weekly expected move is going to kind of come into play at that point. This is the size of last week's expected move. And this is the size of this week's expected move. And you can see that our week is a lot smaller in relation to what it was last week. So the market makers see this as a lower volatility week, and the market is pricing a lower volatility week. We've also got this cyan line here. That's an anchored VWAP that started at the first of the year. And when we're underneath that VWAP, we're in a bearish market. Dun, da, da, da. Not much of a surprise. Thanks, Captain Obvious. And when we get above that level, we're starting to get into a bullish market. But it's not just bullish and bearish. It's more of the idea of where's the money at? We've been through this level a few times, so there's no magic to it, right? There's nothing that says, oh, well, we're above it, so we're just going to keep going up. We got back in March, we got through it. And in that July-August rally, we got through it. The March run that you see here, though, that was FOMC when Apple freaked out and set records on how many days in a row it ran to the upside, right? And then it rolled over and dumped. And then the second time we got above it was that whole July-August rally when all of the breadth indicators changed about mid-July, and we just had like Niagara Falls volume coming in and just massive breadth that swept us right through those levels. It's almost the same shotgun run that we have now. Compare it with March. So we could easily get through that level. It's still a line in the sand. There's some really great work. If you were to Google anchored VWAP Boulevard, I think they have some really great material out on how they focus on the anchored VWAP. And if you talk to Jeremy over at the Bullish Bears, he's done a lot of research on anchored VWAP. He would be the person to kind of get more insight onto this, right? I'm relatively new to using anchored VWAP, mostly because I only use indicators to analyze the market. I don't use indicators to trade it. So to me, I don't spend my days hunting for new indicators. But the anchored VWAP in the last decade has become one of the newest and most powerful analysis VWAPs out there. So it's definitely one to learn more about. Something of note this morning, this is our range in a sideways, boring, sleepy S&P marketplace. And this is US dollar Japan, which broke out around 4 o'clock this morning. And while we are getting a little bit of a rounded reversal now, it stands out. If you put these two mornings in context, and then you bring in the dollar. So we have a very divergent marketplace with things happening that are not causing the ripple effects that we would expect to see. When all three of these markets were going sideways in the overnight hours, it was kind of like, okay, everything is doing what it's supposed to do. All systems normal. Then US dollar Japan had the breakout. The dollar followed suit, so not much of a surprise. Or maybe the dollar broke first and US Japan followed suit. Either way, right? Chicken and the egg question. It really looks like US dollar China broke out first. That galvanized a move in the dollar. Then US dollar China began to roll over right where my mouse is on the dollar, 620 this morning. And it took another 20 or 30 minutes for the dollar to start to turn. But look at the depth and the drop of the dollar already back inside the box. It basically reset the whole move already, while US dollar Japan did not. It's still outside the box and is definitely getting some activity this morning. why bring all this up? Well, the US dollar Japan is still the most watched on the list right now, right? They are working tirelessly to defend this. And one of their benchmarks was Bank of Japan, BOJ, said that we want to keep it below 145. Well, they got it. They're below 145 now. Wouldn't surprise me if they're going to work diligently to keep it below that, but it's already gravitating back up again. Think of taking a balloon and sticking it in the pool. Instinctively, the balloon wants to go to the surface. Now you can push it down, you can get it under the surface of the water, but if you let up, that balloon's coming up. Its default natural state is to go to the surface. That's the market. The default natural state of the marketplace is to go up. The only time it doesn't is when there is external forces pushing it down. So when those negative forces quit pushing it down, its default position is going to be to buoy back up again. Moves up in the US dollar Japan is going to be directly affecting the dollar. And if the dollar goes up, we're very likely going to see the S&P and the NASDAQ go down. Right? It's not a teeter-totter. It doesn't have to go down. But that's what we've been seeing. And if the correlations continue to hold, if things do what they're supposed to do, a rising dollar is going to be equal to a dropping S&P. Right? We're seeing that literally while I'm talking about it. This big green bar here on the dollar and on Japan equates to a big red bar here on the S&P. So when you're trying to trade today, watch the dollar. If you want to understand the move that you're seeing in the dollar, watch US dollar Japan. So hopefully that helps, right? Get a little bit of insight. It's always one step farther, right? It's another step. Last year we were watching the dollar a lot, and the dollar would make big moves. And people would say, why the dollar move like that? And I'd say, I don't know. You have to find someone who understands the dollar more. I don't know what caused it. Because I left Forex to be the last thing that I learned instead of the first thing that I learned. But over the last year, I've been working diligently on learning Forex. And this is the insight that it provides, right? Now we understand why the dollar is moving that way. It's because US dollar Japan is moving. So step by step by step, right? All right, all of our benchmarks on the dollar was that if it held above 110, we wouldn't expect the S&P to rally into new highs, but that we could expect the S&P to and by new highs, I mean that 4,000 pivot. As long as we were holding above 110 in the dollar, we did not expect the SPX to break above that 3,900 level. But if we broke below 110, then we were free for a breakout above 3,900. But we're not just below 110, we're below the 108, which was another benchmark. We get below 108 and hold below it, we could easily see the dollar get above, call it 4,100, 4,150 area. So we want to put it into that kind of context. If we hold below 108 in the dollar, we could very easily see the S&P make its way up to 4,100. Getting through it, getting above it, getting above this pivot point, that 4,100 pivot. I think we would have to breach another level in the dollar. I need to do some more measures before I figure out what that next breach is going to be. but it's looking like somewhere around the 104 area in the dollar. And at some point, these are going to have to just decouple again, right? The dollar does not always drive us like it has been. It's always been something worth watching. But there's times where a strong dollar is a good thing, and then a strong dollar is a bad thing. And over the last, 2022, basically, that strong dollar has been a negative pressure or a negative effect on the market. Beautiful, perfect inverse correlation. But this breakdown does not equal this breakout. So that correlation is kind of untethered a little bit. It's decoupling. There were calls for the dollar to be above 120 by the end of the year. And now seeing it below 108 calls into question that year-end target. So some benchmarks. If you're short or you're expecting the market to go back down, you need the dollar back above at least 108. That'd be a good starting point, and preferably back inside 110 channel. So getting above 110 in the dollar, back inside of this zone here. Getting back above that angled trend line that I have drawn would be your starting point. If we stay below that, then I don't see any slowing down in this current S&P rally. Ten-year. Same thing, breakdown, breakout. 3.88, kind of the line in the sand. If you're looking for the S&P to go back down, you're going to want to see the TNX get back above that 3.88 or 38.8. And if you're looking for a new breakdown on the year, say the SPX getting below 3,500 and dropping into new lows, then you're going to want to see the TNX breaking out on the year through the October high and getting into that 4.7 zone, which was the target on the year, right? That I'm going to keep circling back that a lot of our targets on the year in the dollar, in the yields, they're off the table. I don't necessarily think we need to throw them in the trash yet, but it's really close to that. Then we just wad the whole analysis up, throw it away, and start over. There are some really strong buy flows that are coming in, and it's like standing in a river with this constant pressure against the market. Well, right now it's buying pressure. All right, so we're looking at the VIX. Kind of hard to see this morning, but it is elevated. We closed down here and we opened up here. It very likely has a lot to do with contract changes more than anything else. So if you go to VX, all right, it wasn't that then, because we're still active on the front end, 2 days left. Let's see. Just gapped. It wasn't the FX futures. All right. Well, we're in contango. So we're in normal situation. This is what we want to see, not necessarily as curved as we would like it. You got a really steep, sharp curve at the front, and then it kind of just flattens out. The flattening is a little not alarming, just something to be aware of, right? Like a flashing yellow light when you're driving. When it's really flat like this, it can invert really easy, right? When it's really steep and it's curved strongly, then seeing it invert, it would take a lot more work. So it's only a concern, something to kind of keep an eye on. The China ADR names are still catching a lot of flow. And from what I was reading in the Bloomberg 5 Things You Need to Know, it looks like China is finally going to start to get serious about this housing situation. And they've been doing a lot of stimulus too, but with their nation in lockdown, those stimulus dollars haven't had a chance to really flow out into their economy yet. Baba, Baidu, PDD, Neo, all of those China ADR names are catching flows for a number of reasons. One of them is the state banks in China were told to buy these names. Now, we don't know how much they have to buy. We don't know when that buying is going to stop. So it's a little bit of a concern, right? Because you got to ride the wave, but we don't know when the wave is going to end. Then they keep teasing this idea that they're going to reopen and reduce their COVID-0 restrictions, like start eliminating these restrictions. And then they yank it back and say, oh, no, we're not reducing these restrictions. No, we're not doing that. And so we're getting that seesaw motion, 2 days up, 3 days down, 2 days up, 3 days down. But the constant right now is the state banks buying. So we have that flow. Then a lot of hedge funds were surveyed on, getting back into China again. And out of the 200 and something that responded to the survey, a lot of them said there's massive pent up demand in these China names, and that's the focus, especially tech China. And that's where they're going to be looking at in the next 18 to 24 months. So for tech China, KWEB is a nice ETF to use. This is a basket of stocks, right? It's the China Internet ETF. A lot of the names that are in this basket have really high short covering. So if they start getting squeezed, it's going to be a short squeeze, very likely of epic proportions. The more it goes up, the more it's going to squeeze, causing it to go up even more, squeezing more shorts and causing it to go up even more. I don't think Thinkorswim has the basket. Some names it does, and then some names it doesn't. So you might have to go out to Google to get the names. Yeah, it doesn't have the names. If it had the names, they would be down here. And the fact that it's empty tells you you're going to have to go to Google. Koifin is a really great website that has that kind of data, but Koifin is no longer free. So maybe yeah, the names just escaped me. There's free places out there that you could get the information. Easiest would just be to hit Google and find out what names are in this basket, these China Internet names. But if you're looking at the biggest market cap weighted names, PDD, JD, Baba, Baidu. Another basket is the EEM. This is emerging markets, and China, for some crazy reason, is still considered an emerging market. And this ETF, or basket of stocks, maybe it's an ETF. I keep wanting to call it an ETN, but it's a basket. You can look and see what's in that basket as well. But these are two indicators. I wouldn't want to trade this, right? You don't want to trade the EEM. You don't want to trade KWEB. You want to look at the names that are inside it and then use those two as a proxy, like an indicator. If they're going up, the names inside it are going to be going up. You know, the flows, the strength, things to focus on. This morning, it's range bound like everything else, so not catching a lot of flow in there on emerging markets. But the KWEB names are up really good this morning. They're up a lot better than the rest of the market, right? Think about the ES this morning, down, you know, 0.1%, negligible amount, but this isn't down, this is up. So where's the money this morning? KWEB, China internet stocks. Still continue to hear a lot about marijuana stocks, marijuana companies, legislation on this. They're getting more and more flow, but these are still heavily shorted names. They're worth keeping an eye on if you are believing that we're seeing a short squeeze in the market. You want to find sectors that are really getting squeezed, and this is one of those sectors. Airlines, cruise lines are two others that, you know, during COVID, it came out that their money management, especially the airlines, it's atrocious as a company. I mean, they're just completely irresponsibly ran companies. They get a bad credit score, and then it makes it really hard for them to borrow money. And I know that sounds so benign, but it's really important, right? It makes them bad companies to invest in. If you can't get investors to come in, what do you think their stock's going to do? So when all the cruise lines and the airlines were beat down and everybody kept saying, oh, these are great buys, look how beat down they are. Okay, maybe. I mean, but you're talking about a good buy in the next decade, maybe two, and then you're just going to be bag holding these things forever. You're going to give them to your grandkids someday. Yeah, okay, maybe. But if you're looking for some 2-year return where the airlines and cruise lines come roaring back to life, certainly nothing showing in the flows and even in their own earnings that suggests that we're going to see anything like that. We have a red to green in natural gas. So we closed way down here, 1916. And this morning, we are above $20. So we're opening, at least so far, way up here. I like red to greens, but Friday was a really big level. So what we have to focus on here is seeing this rally hold above the 50% mark, and then get a breakout from where we opened on Friday, and then break out of Friday's levels. And that would put us outside of this IX10 that we've been in. So if we're looking for a rally to begin in natural gas again, and it's up a lot this morning, it needs to get above $21. That would be the breakout of Friday. That's a long ways out it's another 75 cents higher than our current location. And a red to green, the really good red to greens are when we have a market in an uptrend, and then it gets a nice small pullback. That's your red candle. And then we get the green the next day and a continuation. That's a really, really great red to green follow through. It's not so really great when you're in this sideways market and you had a red day and now we're getting a green day. Look at Wednesday and Thursday for a perfect example of that. Red day, green day. That red to green is not inspiring, right? What'd you get out of that? It made most of the move in the pre-market. By the time the actual market opened, you didn't get a lot out of it, and it sure didn't stick. Yeah, the VIX is a European settled options contract or European styled options contract. So the last day that it can be traded by us would be Tuesday night. And then Wednesday morning, you look at the row to see where the SPX opens. That's where they mark it. And that's the Wednesday expiration of VIX, right? But they need the S&P to open Wednesday morning so they can mark that spot. In my VIX school, those 20 videos, I talked about what those different market symbols are. So you can go look at the charts and see where they're marked, what the expirations are, why it's that expiration. So natural gas is looking a little bullish this morning. I would first focus on the 50% of Friday's level. It needs to hold and stick above that, and then start breaking through each of the levels. Friday's open, Friday's high. That gets us outside of the box, $21, and then start working our way up. We did close that gap from back in October. So the next gap is kind of a little too far. We're not going to get there today, that's for sure. 23.84. If we get there today, I would be seriously surprised. That would be that would break things. We're still seeing a rebound in crypto, which is not a surprise. I'm still holding 10,000 as my level on that. But after the massive drop we saw and the amount of work that's going in, you know, everybody's coming out and sweet talking it, trying to convince people that it's still, you know, an asset worth owning or at least considering. So it's getting a little bit of a rebound. And that's, I mean, that's it on the list, because anything below that 50% mark, if it's not up at least 0.5% or down 0.5%, then it's not worth looking at. Gold is down more than 0.75%. So we got a whole lot of wait and see this morning. And what I wrote about on Friday was, okay, we've got these flows coming in and it looks really good. The S&P, the NASDAQ, all the sectors, but it's not going to be a uniform rally. It's not going to be shared equally across the board. When we talk about a rising tide lifting all boats, well, that implies that they're all going to get lifted equally. And that's certainly not what we're likely to see. The top three here are risk on, the mid three are midline, and the bottom three are risk off. So as an economy, not just on a day-to-day basis, bearish and bullish, but overall in the economic environment, when the market is in a bullish environment, the top ones are going to be the focus. And when we're in a bearish market, the bottom ones would be the focus. Utilities, healthcare, consumer staples. We've got some critical levels of resistance that we're coming into on a lot of these sectors. And we want to be focusing this week. This was a rally into resistance. That's what we had. We had a bounce and a rally into resistance. And this week, that resistance needs to be resolved. Now, remember when we were talking about how far away from the 10-week we are. And it implies that we need to pause for a week and let that 10 period get caught up or turn around and fall back down to the 10. I really don't think that's on the deck. Not falling all the way back to the 10. But pausing for a week makes perfect sense, especially when not all, but a lot of these sectors rallied into resistance. So we're in resistance across the marketplace in all kinds of names. We need to resolve that. We got that double top in energy. We've got a double top in building materials, like a really beautiful cup there. Same thing with industrials, financials, healthcare. But we don't have that in consumer discretionary and technology. So a lot of these names aren't what we would expect to rally as a group, right? We wouldn't necessarily anticipate industrials and technology running together, and building materials and healthcare and finance running together. All right. So when we're talking about that rising tide lifting the boats, it's lifting a lot of strange boats. Which ones are going to fall out? Or is any going to fall out? Because it doesn't have to, right? But if we're looking for a capital rotation, we should be leaving something and getting into something else. This doesn't look like a rotation. This looks like a straight on flood, that it's not leaving one area and getting into an area. It's just straight up getting in. Now, one thing we haven't mentioned yet is bonds. And they've been heavily beat down since that. We had that July-August rally in the S&P and the NASDAQ. Well, at the start of August, literally 8-1, this thing has been downhill, nonstop. And then we based for a month, 4 weeks. We had that breakout last week. We got outside the box. But I'm going to argue that this is the box, and that we're not out of it yet. We're using this candle's top and bottom. So we got through the 50%, but we are not out of the top of that yet. Everybody be careful this morning. Keep your eye on who's talking out there and what they're saying. We shouldn't have anybody deviate from the group. We're going to expect them all to be saying the same thing, parroting the same thing. But, you know, you never know for sure. Most of the econ on deck this week, there are a couple that are concerning, but none of them should be big enough to turn this market around by itself. And that's a wrap. I'll see you guys tomorrow.